from an accounting perspective, some key points I think are important to remember with acquisitions. One of them is around business value, and one of the services we can help with is business valuation of a prospective purchase. And a couple of the ways that you might value a business is a multiple of profit, which we talked about before. Joanna, is that like what percentage of businesses you reckon would be done on that basis?
Yeah, most. Yeah.
Okay, like 90?
Yeah, probably. Other than, so accounting practices are different, but
They're a bit special.
Yeah, that's right. But most other businesses will be, well, it depends actually. In the technology space, quite often it actually becomes less about even profit or revenue. It can become more about, like what's the value of this asset, because quite often there won't be and if we have a business that is making a loss or those sorts of things. Yeah. And then when we're in the acquihire, so we're acquiring a business for the talent, we might go back to revenue rather than profit as well. But generally, like I think 90% is a pretty good indicator of the profit multiple versus revenue.
Yep, that's pretty cool. And then that, so we talked about multiple of profit, we've got multiple of revenue, and then kind of whatever someone will pay, and that could
so
be
true.
I think a lot of it's got to do with what's it worth to your buyer, and it's important that maybe the one of the first two options might start the conversation, but who knows where it will go. If we are looking at profit, or this thing called EBITDA, which is I've sort of spelled it out here, the acronym. So we've got earnings, aka profit, before interest, tax, depreciation, and amortization. So depreciation is that write-off of your assets, let's say cars or equipment that you own. Depreciation is claiming a portion of that each year. Interest is interest on any debt. Obviously tax, if it's a company, companies pay tax, trusts don't if you're acquiring from a trust. So that's the acronym we usually apply the business multiple to. Also, you need to remove owner's benefits. So often if it's a small business, the owner might be putting their car through, their mobile, which you don't need to pay for if you acquire it. Any other benefits to them need to be taken out of that or added back to the profit figure. Likewise, this third point here, it says you need to pay the owner. So if the owner's working full-time in the business, but let's say, a lot of our clients are structured as trusts, and usually we take the profit from the trust and distribute the profit. We don't pay a salary before the profit. So we need to go and adjust that profit figure to pay a market rate salary for the, what we need to go and hire someone to pay for that, to run that business. So you need to replace the current business owner. That could be a process in adjusting that profit figure. So anyway, that is kind of covered when if we were to help a client with looking at valuation for a prospective purchase or even their own business. That's some discussions we have.